If you're sitting on a pension and retirement is somewhere in your next 5 to 10 years, then at some point, you're going to have to make a decision between two different numbers. One is a lump sum, a single check, sometimes 6 figures, sometimes more. The other is a monthly number guaranteed for the rest of your life. And here's the problem. Once you pick one, you almost never get to switch back. This is an irreversible decision in retirement planning, and most people, they make it based on which number looks bigger on paper, without understanding the one factor that they should actually be using to drive the decision. I'm Andrew Matz with Oak Road Wealth Management, and today I want to walk you through how to actually think about this. Not tell you what to pick, because there isn't one right answer here. But there is a right answer for you, and by the end of this, you'll know how to find it. Most financial decisions in retirement have some form of flexibility built in. You can adjust your withdrawal rate. You can rebalance a portfolio. You can change your Social Security claiming strategy, at least up to a certain point. A pension election, it's not like that at all. Once you take the lump sum, that pension is gone. There's no monthly check to fall back on if the market has a few bad years. And once you elect the monthly annuity, you generally can't do that either and ask for the lump sum later. Even if your health changes or your spending needs change, you can't change it. So before we get into the mechanics, I want to be upfront. I'm not going to tell you which one to pick in this video. I see this decision go both ways, and both ways can be completely correct depending on the person. What I do want to do is give you the actual framework, starting with the one thing that changes this entire conversation: whether your pension has a cost of living adjustment. So let's start with a distinction that trips up a lot of people because it changes everything downstream. It's public pensions and private pensions. They're often structured very differently. If you work for a state government, a public school system, or another public employer, there's a decent chance that your pension includes a COLA, or a cost of living adjustment. This means that your monthly check doesn't stay frozen for 25 years. It typically increases, often annually, to help keep pace with inflation. Some public pensions have COLAs tied directly to the Consumer Price Index, and others have a fixed rate, like 2 or 3%, regardless of what inflation actually does that year. However, if you worked in the private sector, so for a corporation with a pension plan, there's a good chance that your pension does not have a COLA. Private pensions were largely designed with a fixed monthly payment. What you're offered at retirement is what you get for the next 20 or 30 years, and there's no adjustment for inflation. This distinction matters enormously, and it's the first thing that you should check on your pension paperwork. Two people can have what looks like the same monthly number today, say $3,500 a month, and be in complete different positions 20 years from now, purely based on whether that number moves with inflation or sits still. I do want to be careful here because this isn't universal. There's private pensions with COLAs and public pensions without them, or with COLAs that actually get suspended in certain years due to funding levels. So don't assume that based on where you worked, go find your actual plan documents and see what your specific pension actually says. But as a general pattern, this public versus private divide is real, and it's a starting point for this conversation and decision. Let's put real numbers on why this matters, because cost of living adjustment can sound like a minor technical detail until you actually see it play out over a couple of decades. So if you have a pension that's paying $3,000 a month, and that pension has no COLA, in 20 years you're still getting $3,000 a month. But what that $3,000 buys has shrunk. So at a 3% average inflation rate, something that costs $3,000 today costs $5,400 in 20 years on average. So your check hasn't actually lost dollars, but its purchasing power has lost more than half. Now let's take that same $3,000 pension, but with a COLA. 20 years later, the monthly payment has grown to roughly match inflation. So you're still buying close to the same basket of goods that you could buy on day one. This is the single biggest reason that a fixed monthly pension without a COLA can look great in year one, but feel painfully thin by year 15. It's not that the pension failed, it did exactly what it was designed to do. It wasn't just designed to keep up with rising costs. So this is also why the lump sum conversation becomes so relevant for people with non-COLA pensions. If your monthly check is never going to grow, you do have to ask yourself, is there a way to build that growth yourself? Now here's where it gets really interesting. If you were to take the lump sum instead of the monthly pension, you're basically trading a guaranteed check for a pool of money that you now control. The appeal isn't just having more money today, it's that a properly invested lump sum, typically in a diversified mix of stocks and bonds appropriate for your age and risk tolerance, has the potential to grow over time. And if it grows faster than inflation, you've essentially built your own self-directed cost of living adjustment. This can be especially compelling for someone with a private pension that has no COLA at all. Instead of locking in a monthly number that's frozen for the next 3 decades, you take control of the capital and structure withdrawals that can increase over time, much like a COLA would, but with no guarantee attached to it. And that's important to keep in mind. There are a few other reasons that people lean toward the lump sum. It becomes part of your estate, meaning that if you were to pass away, the remaining funds can go to your spouse or to your heirs. Compare that with a pension election, where it may actually just stop or reduce sharply at death, depending on which survivor option that you chose. It also gives you flexibility. If you have a large unexpected expense, like a health event, helping out a family member, a big home repair, those dollars are accessible, where a monthly pension check is not. But, and this is very important, none of that growth is guaranteed. None of it. You're now taking on market risk, sequence of returns risk, the risk of outliving the money if it's not managed carefully. The lump sum isn't a free upgrade. It's definitely a trade. You're giving up a guarantee in exchange for control and growth potential. Now, let's get specific about what building your own COLA means in practice, because it's not just invested in hope. When someone has taken a lump sum to help their dollars keep up with inflation, the conversation usually centers on a few things. First, we have asset allocation. A portfolio designed to outpace inflation over the long run typically needs meaningful exposure to stocks, not just bonds, because bonds alone often struggle to keep pace with inflation, especially after taxes. That doesn't mean going all in on stocks either, though. It means finding a good mix that reflects both your growth needs and your ability to stomach volatility. Now, second, we have withdrawal strategy. If you're pulling income from this portfolio consistently to replicate a monthly check, for example, that's entirely okay, but the withdrawal rate matters. Pull too aggressively in the early years, and you can permanently damage the portfolio's ability to last. This is what's known as the sequence of returns risk. Finding a safe withdrawal rate is very important. Third, we have time horizon and health. Someone in the early 60s with a long life expectancy has more time for the growth argument to play out. The math genuinely changes based on how long this money needs to last. This strategy, it can actually work, but it does require real discipline, an actual investment strategy, and of course the willingness to accept some year-to-year volatility in exchange for long-term growth potential. It is not automatically the better choice just because it feels like the more modern, flexible option. Now, I do want to push back on the idea that the lump sum is always the smart move, because it's not. There are very real reasons that someone might choose the monthly pension, even knowing that it has no COLA. The payout rate might just be excellent. Some pensions are calculated using formulas that produce a monthly income far higher than that you could safely withdraw sustainably from an equivalent lump sum. If the plan is offering you a high payout rate for life, that can be very difficult for a self-managed portfolio to replicate, at least initially. Also, longevity protection has real value. A pension keeps paying as long as you're alive, full stop. If you or your spouse come from a family with a lot of longevity, or you're simply someone who doesn't want to think about running out of money at 88, that guarantee has genuine value that doesn't show up cleanly in a spreadsheet. Lastly, peace of mind is not a small thing at all. Some people, they could mathematically come out ahead with a lump sum and still choose the pension because they don't want to worry about market drops or second-guessing withdrawal decisions in their 80s. And that's a completely legitimate reason. Retirement income isn't only a math problem. It's also about how you actually want to live and what lets you sleep at night. These are some of the decisions that we work through with clients at Oak Road Wealth Management. Typically, we work with people who have somewhere between $1 and $2 million that they have saved for retirement. And we help them create confident retirement plans. When we look at decisions like this, we're not just comparing the lump sum's projected growth to the pension's guaranteed payments in isolation. We look at the entire picture. We look at your other income sources, your spending needs, your tax situation, and how either choice fits into the rest of your retirement plan. Sometimes that analysis points cleanly one way, but very often it's closer than people expect, and the right answer comes down to which trade-offs actually matter to you. If there's one thing I want you to take away from this video, it's this. Don't make this decision based on which number looks bigger. Find out whether your pension has a COLA. Understand your payout rate. And lastly, very importantly, be honest with yourself about how much you value control and how much volatility you could handle. If you want a second set of eyes on your specific pension numbers, the link to schedule an introductory call is in the description below. And if this video was helpful, please like and subscribe. But otherwise, thanks for watching. I'll see you in the next video.